Hey everybody, this is Brant. I think we got 16 people here. Give it a minute here. Can everybody hear me? Just maybe throw something down in the chat if you can. Okay, so I'm gonna open up my chat hopefully here. All right, good morning. Let's see if I can just open this one. I'm still, guys, this is still my I think my fourth live chat. I've had a couple boo-boos, like talking for 10 minutes on the wrong chart and stuff like that. So hopefully we'll do better. Let me just see if I can get some messages up here. Okay, in any case, what we are looking at, other than my ugly mug, which I'm going to get off the screen here shortly, is really what took precedence over the market this week. And that was pretty darn surprising because I really thought that we were going to be dealing with the Fed, with Powell before Congress, and then, of course, the payrolls report, which is what started this whole entire rise in yields over the month of February and into March, and has really caused the pullback in stocks, or the correction, at least until this week. So this was the worst week of the year. So I'm going to transition. The chart that you're looking at, hopefully, is SVB or SIVB. Was it Silicon Valley Bank? I had never heard of these guys before, but apparently they're the 18th largest bank in the U.S., or were. So they were down like 60% on, what was it, Thursday, I think, right? And then down 65% in pre-market on Friday morning, and then regulators just shut them down and put whatever they could into a kind of like a FDIC insured thing. But I can't remember what the exact percentage was. I think it was like something like 5 or 10% of their deposits were insured by the FDIC. The rest weren't. So these VC funds were advising all their clients, like, get out now. And it was basically a bank run. So I want to show you this one slide real quick. And this is something I've been saying to my members for quite a while. It's like, what happens is the Fed hikes rates until they break something. So they always shoot for the soft landing, but they never achieve the soft landing. So these are, different crises from the U.S. Federal funds rate, target rate. You can see it going up. Latin American debt crisis, the 1987 stock crash, the tequila crisis, savings and loan crisis, long-term capital management, the tech bubble, goes on and on. So the Fed always shoots for a soft landing, meaning like not hiking too much, not doing too little, and just coming in nice and soft and not having a recession. But they never do that. They never do that. Something always breaks. And as Michael Hartnett said this week, which I thought was really interesting, he's like, markets stop panicking when the Fed starts panicking. So the question really is, is this like the start of a systemic banking crisis? I don't know that. I really don't think so, but I don't know. So I want to just show you a couple other slides real quick. This is for my subscribers to Wolf on Wall Street Trade, and this was the daily wrap of Wednesday, right? Wednesday night. And I've been talking about this on and off for a little bit, but you can see, daily wrap March 8th. And then the next slide here is the two things that I was talking about that to me were bothersome at that point on Wednesday night. One was high yield credit wasn't acting great, and the other you can see highlighted here. The other signal I find troubling is how much the yield curve has flattened over this last month. This tends to affect and lead the banks lower, right? Or tends to affect and lead the banks the most. It can be lower or higher. The point is, though, this was the night before basically that bank fell apart and lost 60% the next day. So I'll just go to the next slide. I have these on the website for subscribers, but it's just easier for me to pick it up here from Twitter. So you can see, this is what I was talking about and warning my subscribers that the yield curves flattened so much over the last month. That's because rate hike projections have gone up, right? And it leaves the banks lower. So this was BKX, which is the KBW Bank Index, and the yield curve I have here in white is the 5-30 yield curve. And I'm going to show you what that chart looked like as of Wednesday night. So here is the yield curve. Hopefully you can see that. Let me just check the comments real quick to make sure I'm not doing something I shouldn't be doing. Everybody's there. Are the bulls doomed, Adam? We'll talk about that. I'm clear. Good. All right, cool. Cool, everybody. B. Rent, Mr. Bob. All right, cool. Glad to have you guys here. So let me get back to what I was talking about here. So this is what it looked like as of Wednesday night. I think this is the actual chart I pulled from the post of Wednesday night for subscribers. And what I want to point out is, this is the KBW Bank Index in the candlesticks, and the white line is the 5-30 yield spread or yield curve. And you can see when it flattens here, it tends to lead the bank stocks. And you can see the bank stocks here, the KBW Bank Index, following lower. And then as we come into the October lows over here, what are they doing? They're leading higher right over here, okay? And that starts that whole October rally that we're truly actually still in right now. If we look at, just the basic price action of the market. Been a very bad week, the worst week of the year. But here you can see again, negatively diverging, leading the banks lower. And in December, we had this 2-week, first of all, we had like a nasty pullback in December in the market. And then we had this 2-week period towards the end where mega caps were being dumped. And the market was just kind of trading sideways for about 2 weeks here. And the argument I made, and this is what I went over in like some detail in that Wednesday post. Maybe I'll post that Wednesday daily wrap for non-subscribers just so they can get like a taste of, what we do and what was being said. But back here in December, it was like a really ugly market, just really low conviction, really couldn't tell what it was going to do. And the case I made was because the yield curve was leading higher out of this little like 2-week lateral range that, excuse me, I'm on my sippy cup there, that the probabilities are that the banks are going to rally. And what are the probabilities that the banks rally and the broader market doesn't? So that was kind of what I was saying. Like, I think the broader market is going to come out of this into the New Year rally. But look what's happening as we get into this rally. Again, this yield curve flattening. What is all this flattening about? This is the February payrolls report. It's actually the January data that came out early in February. And it's been nothing but hot data since then, which has sent this yield curve lower with Fed rate hike expectations moving higher. This is what the banks looked like as of Wednesday night. I was saying to my members, this is a scary chart to me of 2 that night. And I'm going to show you what happens next. So this is the very next day, Thursday. There's the KBW Bank Index. Look how it just catches down to the yield curve. Now, I expected this to happen. I didn't expect it to happen in a single day. So that was quite a shock. And the market really is now kind of in this risk off mode of, okay, the Fed is now breaking something. Is this systemic or is this a one-off thing? And it just took risk sentiment down completely. Bonds actually just shot through the ceiling. And typically, when that happens, yields are going to drop really hard and the stock market rallies. But there's 2 different things going on there. One is a flight to safety into the safety of bonds, right? The second is Fed rate hike expectations coming down like significantly for the week. And the third is the net spec short position in bonds is it's just off its record high. So a lot of bond shorts, so they were getting squeezed. They were covering, which was sending treasuries higher and bond yields lower. So in any case, what you can see is that we just basically caught down to the yield curve in one day. I thought maybe it happened over a week or so, one day. So, and this last chart I'm going to show is what's happened to market expectations for the Fed over this last week. So pricing in over 3 rate hikes about Tuesday of the week. And then now by the end of the week, it's pricing in like a half a rate hike. Doesn't quite make a whole lot of sense because the March rate hike is still at like 40 to 50% probability for a 50 basis point hike. But that's come down significantly. So it's kind of leaning a little bit more towards a 25 basis point hike. So with that, let me just check the comments again. Guys, I'm still running like an incredible amount of software here and screens. Quite a volume bar on SPY. Okay, yeah, Mark, quite a volume bar on SPY's daily chart yesterday. So what I was telling my subscribers is that we should be looking for, this is SIVB, that bank that collapsed and is now kaput. But let's take a look at SPY. We'll take a look at the volume. Of course, it's a Friday, so volume is going to be a little bit heavier. Actually, I got to go to this chart, and we'll pull it up. But what I was telling my subscribers is what we need to be watching out for is like a seller's capitulation event. And typically that happens on high volume. That happens when the market's really oversold, and market internals were both one day oversold, like heavily, on Thursday and Friday. And I'll get to some of those other charts. Let me just take a look at the comments again real quick. Hey, Katie, Tony. Hi, guys. Thanks for joining us. B-Rent. Okay, we got all the good people here. Okay, anyway, so I've got a whole bunch of notes because so much happened this week. As far as the payrolls, kind of a non-event. You know, the market pretty much ignored the payrolls. Payrolls came in a little bit hotter than expected, right? But down from January's print. The unexpected development was that the unemployment rate ticked up and wages ticked down. So that's actually a pretty positive thing. And the market really didn't react much to the payrolls. I'm going to transition over to TC 2000 here. And I'm going to show you the 10-year yield. So I've been talking about a window of opportunity that these mega cap stocks can really rally into and sink their teeth into. And what I was saying was that this trend, this February trend, this is right where that first February payrolls report came out. Then everything was hot. CPI, PPI, services, all that stuff was hot. I was saying the window of opportunity to me is when this trend breaks and the dollar breaks. Now you can see basically the flight to safety, the discounting the Fed, all that right down here. So this is the 10-year yield we've looked at. Resistance at that 4% level, which looked good. Didn't expect it to come down this much. But I think on the week, let's see, the 2-year yield, just on Thursday and Friday, it plunged like 50 basis points and down 30 for the week. So those 2 days, that 50 plus basis point drop, that's like the biggest drop in the 2-year yield over a 2-day period since Lehman. So you can see why the market's a little bit freaked out. You know, is this an isolated event, or is it something that's systemic and that's brewing and puts the Fed in a really, really bad spot? So the Fed's terminal rate was at least 5.75 early in the week. It came down by 55 basis points. And we're looking at basically, let me see if I can pull up this PowerPoint one more time and find the, oh, I don't have the, yeah, I do. Okay, maybe I already showed this to you, but I'm going to pull this up one more time. And here we go. So basically what's going on here is, you know, from over 3 rate hikes priced in, and in those couple days, a half a rate hike. So it's looking a little bleak. It's putting the Fed in a uncomfortable position where if they have to provide liquidity or basically QE to bail out the banks, what's that going to do to inflation? That's the last thing they want. So in order, I think the Fed is most worried right now about inflation, more so than a recession. They actually want to cause a a recession to get inflation down. But the one thing they might worry about more than inflation is a financial crisis, something breaking down in the financial system. So this SVB bank kind of looked like that, or kind of got people a little bit worried about that. I'm going to take a look real quick at the comments again. How did you plot yield spread in TC2000? Yeah, okay. Let's take a look at that. Let me transition. I got to keep reminding myself to transition these charts because I really am kind of running like a TV studio here. Okay, so we should be looking at, that's HYG. Let's go to the 530. So it's just subtracting the 30-year from the 5-year, and you can do that with FVX for the 5-year and TYX for the 30-year. And then I've just plotted the banks here. Actually, that's the name of the banks. Here's regional banks. But let me show you again, what I'm talking about. This is what we looked like, earlier in the week. That's not scaled great, but the point is the yield curve was leading down and the banks really caught up to it. Now, the last 3 days of the week, we did have some yield curve steepening. I do want to make mention of something. So you hear a lot of people talking about, the yield curve inverting and that being a really significant, reliable indicator recession. So I think it's predicted, basically when it inverts, it's predicted like every recession since World War II, the 2-10 spread. But what happens is the yield curve inverting, and it was like down over 100 basis points, like in inversion, the 2-10 spread, like the most since 1981 earlier this week. That is the warning signal. What generally happens though, right before the recession, is you'll get a real sharp steepening in the yield curve. Now, I'll tell you what that is, and then you get the recession right after that. So first inversion, and then sharp steepening out of inversion. And that sharp steepening is the Fed cutting rates because they see something coming. Now, the Fed doesn't want to make the mistake that Paul Volcker made in the early 80s. So he hiked, I think, the Fed funds rate up to like 17, 18% in the early 80s to kill inflation. Inflation started coming down. There was a recession. He came under political pressure to start cutting rates to deal with the recession. He did that, and inflation resurged, and then he had to go back to like 19 to 20% on the Fed funds rate, and then endure another like double dip recession. So every time you hear Powell say, the historical record, cautions us against, prematurely pivoting, that's what he's talking about. He's talking about that kind of mistake that was made in the early 80s that led to resurgent inflation and a double dip recession. But if the Fed is facing a systemic financial crisis, I think that's a big part of why yields came down so much, is because the market just started looking at the fact that the Fed may have to do QE. And again, we can see that here on this 10-year yield, how much it dropped. Let me just see on the week. I'm going to do like a quick weekly. So almost 27 basis points on the week. So, a Fed rate hike is considered like 25 basis points at a time, or they do 50. So it's basically one rate hike by the 10-year, at least, discounted. If you look at the 2-year, so down about 30 basis points for the week, same thing. So it took off about 25 basis points of Fed rate hikes, down 50% or 50 basis points Thursday and Friday. So really got like, the Fed's going to have to provide liquidity or do QE, which is the last thing they want to do because that's going to cause inflation to resurge. So let me take a look at the comments again. I know that I should really, give me just 1 second. Let me see if I can get these on my screen, because I do have a screen up that is making sure I'm on the right charts, but I'm not getting the comments on that. Anyway, let me just, give me 1 sec, guys. Show me your comments. Show me your comments. All right, well, I guess I have to keep going back to that screen. Thought I had this worked out around midnight last night. Okay, so let me just check those real quick again. Yep, bull steepener Tony. Patrick Flanagan, we've had a lot of correspondence this week. He sent me some fantastic charts. This is why I can't wait for the new website to be up. And it's almost there. I'm kind of like just tweaking stuff. And I've got the Discord room set up. But I get so many good charts from so many of you. And I really want you guys to be able to interact and share those things with each other. So that's, one of the big things I wanted to add to the new website is this room where you can all interact. Hopefully we'll keep everything on topic, and I've got a great bunch of people, so I'm not too worried about some of the problems people have in chat rooms. We have traders that take responsibility, and investors that take responsibility for what they do, and that's what you have to do. The rooms that you have traders that are like, oh, it's your fault, those guys are going to lose all their money. If you're not taking responsibility for what you're doing, you are in trouble. Okay, so let me go back to my list because I did make a whole bunch of notes. There's just so much stuff happened. So SIVB, they're done. Fed always breaks something. We talked about that. The payrolls, we talked about that. So a little bit hotter than expected on the establishment survey, but that was offset by the unemployment rate ticking up and wages ticking down more than expected. I showed you what we were looking at on Wednesday night. Actually, I've been looking at this for a good part of the last couple of weeks, and that's that yield curve, and that it was leading banks lower. Let's transition to that again real quick. But again, just take a good look at it. And you'll see, this is like for banks, if you're trading banks, like this is one of my favorite indicators. You have to watch how it diverges. So over here, you have banks rallying into a divergence. That's no bueno, okay? Pulls them lower, get a little relative divergence here, a little bounce, right? And not a higher high. So again, no bueno, little positive divergence, little bounce, no higher high here. So no bueno. And then into December, this is what I was talking about, looked pretty good. But when we came into this last week, it was just horrendous. This was a really concerning chart for me. That and high yield credit, which is one of my favorite leading indicators as well. But for banks, this is the one you can, if I was trading banks alone, this is what I would be watching all the time. Now, sometimes it's like, you get a divergence in the yield curve with the banks, and it could, lead in a day or two. Usually it's several days, but sometimes it's several weeks. But you can see this is not really too long. It's about about a week or so before the banks really caught down. Like I said, I didn't expect them to catch down all at once. Checking the comments again. Yeah, Patrick, I think it's just going to be great for you guys to be able to interact with each other and share these insights that you guys are sharing with me, because a lot of this stuff makes me think. I'm like, wow, that's pretty interesting. So a lot of different perspectives, and I always appreciate that. Believe it or not, I really do, because I am an eternal student of the market. So we went through the terminal rate, came down from at least 5.75 by 55 basis points. So the Fed's going to be in a pickle come March 21st, 22nd. That's the FOMC meeting. By the way, we have the CPI, PPI report out next week. Those are going to be just as important as the payrolls. And Powell made reference to that in his testimony before Congress. But I think, the Fed is going to be a little bit worried about what happened this week. I know the Treasury Department had like some kind of emergency briefing for the House Financial Services Committee, I think it was. So let's get to some charts here. Make sure I'm not losing anybody. Okay, and let's see, what are we going to start with? Let's take a look at some 3C charts. Actually, let's take a look at some of the averages, because as ugly as this week was, and I'm going to go ahead and transition back to TC 2000. As ugly as this week was, and we'll go through it real quick. SP 500, right, on the week. Wrong one. So on the week, up here you can see the weekly loss, 4.55%, worst week of 2023 so far. Dow, down 4.44%. Here's what's interesting. NASDAQ actually outperformed. So it's down, but it's down 3.75%. Now that's less than half of what small caps were down 8% on the week. So small caps actually really hammered. We don't need this 100-day, but you can see what happened here. Breaking through that 50-day, breaking through the 100-day, breaking through the 200-day. Small caps have a really, really heavy weighting towards value and cyclical stocks. They don't get any of the benefit from the mega caps that have been outperforming, and they have a ton of influence from the regional banks. So that would be KRE, the regional banks that you see. So we got this big drop. Look how we ended Friday with this kind of huge star. Does it mean, we've hit a bottom? I don't know. But what I do know is that in basically 2 days, we caught down to that entire yield curve divergence that I thought maybe it'd take a week or two to catch down to. My sippy cup again. But we do have some bullish charts. We have some that are really screwed up now. Let's take a look at SP 500 real quick. It had a bull flag, right? Here was the bull flag. Looked like it might be doing a little head fake there or a bear trap. And here we get this kind of bounce up. It shouldn't come back down like this, like it did, right? And this 4,000 level right here has been a tricky level for it. So just like psychologically, it's been a tricky level. But here, we're coming into Powell's hawkishness, and here we're coming into the bank collapse. IWM, it had a bold flag, small caps. Now this could still be, it could turn around and turn it into a bear trap. If we look at the daily chart, it did break below 50, 100, and 200-day moving averages. That's no bueno, but we do have a lot of really oversold things. Let me show you what did hold up. Now, what have I been talking about like all year? Like a rotate, all year being 2023, is a strong rotation from, so far it's mostly been the defensive sectors into the mega caps, somewhat from the cyclicals too that led the first leg of the rally from October. So if we look at the NASDAQ 100, which has a lot of mega cap exposure, it still is holding up in this bull flag. So this is impressive. If we look, like I look at the mega cap index, MGK, just for consistency. You can use whatever you want, but be consistent about it. And then I always compare that to the S&P's equal weighted index that doesn't have the cap weighting like the benchmark index. So on the year so far, year to date, including Friday's losses, the S&P equal weight index is down 0.90%, so almost 1%. The mega cap index is up 7.15% so far, year to date. So 625 basis points of outperformance. That is really spectacular because they were the dogs of last year. Anytime rates like popped up, yields were up 4 or 5 basis points, they were lagging the equal weight index by 7,500 basis points. Now we routinely see them, even on down days when they're not really in rotation, they're routinely at least performing or outperforming. So the mega caps are still holding up well. We got the NASDAQ 100 that's showing that. I'll show you a couple other really important charts. The most important sector, or the most heavily weighted sector, the technology sector, it's still got a bull flag, right? What else do we have? Another mega cap heavy sector is communications, right? It's got Google, Facebook, or what's now Meta. So we have a bull flag there, right? And then, although consumer discretionary is actually cyclical, it has so much weight in it from Amazon and Tesla that I just lump it in with the mega cap heavy sectors because it tends to act more like them. So you can see it too is holding up in the bull flag. So these are some of the few areas, or MGK, the mega cap index. So these are some of the few areas that are still looking good. And what I've been talking about really is a window of opportunity these stocks need, because what they've been doing is this pullback as yields have been going higher over the same time. If this happened anytime last year, these stocks would be lagging the S&P index by 500 basis points by this point or more. So they're holding up really well. This is the window of opportunity I was talking about, was a break from this this uptrend in yields, this hotter data from February. Right there, that's a Friday. See, Friday up in the left-hand corner. Friday, February 3rd, that's when the payrolls report came out. Then we had the CPI, the PPI, everything was hot. So this is that break in trend now I was looking for, the window of opportunity. And also with the US dollar index, I'm going to just cue that up real quickly and show you something that I think is important. Let me just add a study to it before I, oh, it seems to be not connecting very well here on TOS. Well, let's see if it comes up. Anyway, if it doesn't, which it doesn't look like it's doing. Anyway, so the dollar index bounced a little bit with yields, right? With this bounce in yields. It didn't bounce as much. It was more supportive. So usually it's been tracking really closely. So it's been more supportive. It hit its 100-day right up in this area. I could pull up UUP real quick. I don't know if it's kind of similar. UUP is the ETF, but we will pull out the 200, 100. So I got the 100-day on UUP in light blue, and the dark blue one is the 200-day. So the dollar did find resistance and it started to back off. So these were the things I was talking about, were a window of opportunity. Now, did I expect that we were going to have a mini financial crisis this week? No, I mean, we're all looking towards payrolls. That was definitely something I was had my eye on, not as a financial crisis, but as the banks really dragging us lower. So I do think we do have some bullish charts still. Let me check the comments again real quick. Was the last comment from Patrick? Just trying to see if there's any new comments there. It doesn't look like it. Okay. So I'm missing something here. Okay, so the other things, real quick, let me pull up HYG. I'm going to go to a different chart here, and then I'll pull it up for you guys. High yield credit was looking disturbing to me this week on Wednesday, where it had been kind of leading off the recent lows. And what I'm going to do is just change the scaling a little bit to make it easier for you to see. And we'll transition over to Stock Finder. Okay, and what you're looking at now is the S&P 500 and high yield credit in blue, and I'll show you what I'm talking about as far as that relative positive divergence. So the S&P actually coming down a little bit this week helped HYG. So it was over in this area where we had a positive divergence and we started to get that bounce, right? And you can see the market came down. This is still not scaled great, but the fact is, if you look at the S&P, you got a lower low here, you have a lower low here. With HYG, you do not have any lower lows. So this is still a relative positive divergence. It's not the strong screaming signal that jumps off the charts and is like, hey, wow, like it has been before, but it's still holding up okay. So this is an area that we want to watch because basically this is institutional money's playground. They use HYG. It's so deep and liquid that they often use it as like a proxy for S&P futures. Now, of course, it's high yield credit. So this big dump in rates this last week over this whole banking crisis definitely helped out HYG. So I'm not sure that we're quite seeing risk sentiment there yet, but we do have a relative positive divergence. As far as VIX, let me just unscale this. As far as VIX, we had some real relative weakness. And what happens is VVIX's trend tends to lead VIX's. So I'm going to pull this up real quick. And what I'm going to do is invert the S&P. And generally speaking, what should happen is VIX should trade pretty close to the S&P inverted. So I'll show you as the S&P over here. Now remember, the S&P is inverted, so what you're seeing here is a decline, and this is VIX in blue. So this is the S&P right here, successfully testing its 200-day once, twice, 3 times, relative weakness in VIX, right? So this was actually a bullish signal saying, look, S&P's holding up at its 200-day, and it's starting to move off of it. This is kind of it just destroying that relative weakness trend with the last 2 days of what's happened. But I'll show you VVIX too real quick. VVIX tends to lead VIX's relative performance trend, if that makes some sense. So what we're seeing here, let me pull in a little bit closer, just too far out. This relative weakness trend in VVIX was much sharper, much earlier on than in VIX. So again, I can just compare it real quick for you. Here's VIX again. So that's what I watch VVIX for, just like relative performance kind of trends. Let me check the comments again because I have to go to a completely different screen to do this. Yeah, Adam, you're exactly right. So Mark, let's see, 38.54 is 20% from all-time high in SPX. Do you think this new level has significance? The 20% thing, no. You know, financial media is all about the 20. Like, look, I did a whole video back in November. I think it was in November, where the Dow had rallied. Let me pull up the Dow real quick. And transition the chart so you're looking at the same thing as me. So what I had done was a whole video about this rally. So this was kind of like a W bottom in October, right? And the Dow basically rallied about 20%. Let me pull up my little pointer here. And over here, you'll see the percentage move. So it rallied, you can see 20.4%, so something like that, over 20%. So the financial media, you know, which by that I mean CNBC, and I never watch them ever, unless I'm like watching Powell live giving a press conference or something. But the financial media is saying, oh, we're in a new bull market because the Dow has done this. It's like, no, we're not in a new bull market. That was the whole thing of my my spiel, is like, you know, you got to look at the primary trend. We do have an interesting thing in the primary trend. But what I was telling my subscribers when we came into this kind of October thing was, I'm looking for the market to transition from a primary downtrend to a intermediate lateral trend. And we can, up until this week anyway, well, still, we can see that in IWM. Here's the primary downtrend of lower highs and lower lows. And then here is the lateral trend that I was looking for. You know, I think this is, it was in the summer, I don't know, maybe September, August, something like that. But this is what I was calling for and looking for. No more than that. I wasn't looking for a new bull market. So I've had this thing about phase 1, phase 2, phase 3. Phase 1 is the market rallies, which is what we've been seeing since October. On, I don't want to call it a Fed pivot, because it's not a pivot. It's really been a step down. So from like 75 basis points down to 50, down to 25 basis points. Basically, peak inflation and peak Fed hawkishness, which doesn't mean inflation isn't super high and the Fed isn't still hawkish. It just means peak, like we're coming around the bend. So phase 1 was what I expected, was a market rally on that. Phase 2 is the bill comes due for fighting inflation and hiking rates. And hiking rates, eventually something breaks, the bill comes due, that's a recession. We already know that's going to happen because the 2-10 yield curve, you know, if you want to bet against it, that's fine, but you're betting against something that's like, you know, 9 out of 10 or 10 out of 10. So probabilities are, yes, we're going to have a recession. My thought has been the second part of this year, phase 2. So I think the market will probably make a new primary, it will reinstate this primary downtrend. Phase 3 is going to be basically nobody wants to own stocks and the market's going to bottom. And the market should bottom before we actually come out of technical recession, before jobs recover and all that stuff. But that's phase 3. That's down the road. I'm thinking, you know, well, I guess it depends. If we do have, you know, a financial crisis and the Fed has to provide liquidity to these banks, that liquidity ends up in the stock market. So who knows? But that's how I've been looking at things. Let's see, what else do we have here? We went over TNX, the most shorted index. I don't even know if that matters, but I can pull it up for you. Most shorted index really, really affects small caps the most because it's just full of smaller companies. A lot of them are value oriented, banks, stuff like that. I'm just going to pull that up and show you real quick. Because what happens is anytime this most shorted index moves, it affects small caps the most. And give me just a second to pull this up. Okay, almost there, almost there. All right, let me transition over for you. I'm getting better about these transitions, aren't I? So this is the S&P 500, and in white is my most shorted index. So you could see, like on Monday, short sellers really stepped in right in front of Powell's first day before Congress on Tuesday. And then you can see them really stepping in again here on Thursday. So if you look at the S&P 500, you can see how the most shorted index has been showing, short sellers piling in here and piling in here. But if I change this to IWM small caps, you can see it tracks almost exactly. So when we see moves in this most shorted index, it affects small caps the most. That includes short squeezes. So if we did get a short squeeze, small caps would benefit from that the most. But right now, I like NASDAQ 100 the most because it's the mega caps that are still carrying this market. One other thing I want to show you was how gold's been acting. Gold obviously probably got a little bit of a safe haven bid from everything that happened towards the end of this week with the bank collapse. But gold and stocks, ever since the Fed started hiking rates about a year ago, gold and stocks have had the exact same inverse correlation with the dollar and with yields. So they move opposite of the dollar and the yields. And I'm going to pull up one more chart, set it up for you real quick. And then I'm going to show you. And what I'm going to use is the SP 500 if you want to follow along. And I'm going to add the ETF for gold, which is GLD. We could use gold, but my TOS is not up at the moment. And let me get to a right time frame, and then I'll kind of transition this chart for you. This is stuff in videos I typically edit out so you don't have all this wasted time. Okay, here we go. Make this, well, yellow is not a great color, but let's say light blue. Yeah, okay. So let me transition this so you're looking at the same thing as me. Should be looking at the S&P 500 in the red and green candlesticks and the GLD, the gold ETF, in blue. So you could see that before the Fed started hiking rates, there wasn't a really strong correlation, but right over here where the Fed starts hiking rates, we start to get a really strong correlation between these two assets, which is a little bit weird. Sometimes it happens, but it's because of the high degree of inverse correlation with, sorry, my chart's going a little bit slow here, it's lagging, with the dollar and yield. So if we actually look at what gold did over this really recent period, that's a 2-hour chart. So let me go to like maybe a 15-minute. And still waiting to, I got so many things open here. It's apparently slowing my system down a little bit. See that huge jump in gold? Flight to safety, dollar crashing, yields crashing. But if we look at this, look how interesting this is. Coming into January, right? Gold's almost leading higher here for the same reasons, right? It's being driven by the same two inverse correlations. And then you see into this February high. By the way, this is exactly where the S&P made that 4150 measured move target. That was coming from its base in October. That was my call, 4150 measured move target. And then after that, the most likely thing to happen is consolidation, which is what we started here. But you can see gold kind of leading lower. It's reacting more, basically, it's reacting more to that sharp rise in yields and the dollar than the stock market was. So I kept saying this, the stock market is holding up incredibly well considering what happened over the last month. Not so much with the dollar, but more with yields, that huge move in yields. But if we look closer at this week, is gold starting to, we have kind of a higher low over here and it's starting to lead. So is gold starting to lead? Well, gold is acting the way I would expect it to act based on what happened to the dollar and to yields over this past week. So these are the same things that, when I say a window of opportunity for stocks to rally, it's these conditions that have sent gold higher towards the end of the week that I've been looking for. So we have them. So that's bullish. That's helpful if the market doesn't remain in a complete all-out panic that the financial system is going to collapse. I kind of tend to think that, until we see some stress in like the FRA OIS spread, the TED spread, I would kind of look at it as more of a kind of one-off thing and just freaked everybody out. But that's not to say it can't happen later. I just don't think it's a real high probability right now. I think it's more of an isolated incident. But the more the Fed hikes rates, the more things are going to break, and you never know where they're going to break. Let me check the comments real quick. So yeah, Adam, that's what I was just talking about. I'm thinking Fed stepping in sooner than later is bullish. Promise bank issues may prompt and fixed income safer 5% returns will suit more. Fed's in a tricky situation if this becomes a crisis, because the one thing I think that scares them more than inflation is a financial crisis, like a breakdown in the plumbing of the financial system. And if they have to respond to that with liquidity and QE, which is kind of what everybody's hoping right now, that's why you see this kind of dump in yields, that's part of it. That's going to bring back that Paul Volcker resurgent inflation probability or possibility, and maybe a double dip recession. So they don't want to do that. Believe me, they don't want to do that. Looks like my theory holds water that gold is leading here in the short term. Mario, hey Mario. I didn't even know that we were so close. I think you're on the other side of Florida from me. Maybe one day I'll get over to the West Coast. I love it over there, Naples, Sanibel. Any thoughts on when to enter that next upturn in SPY? So let me pull up some charts on StockFinder. And I am going to set this up first, and then I'll transition you over. So let me pull up the SPY. The 1 minute chart here. Here we go. So I didn't see anything in the averages really towards the end of the week that was doing anything other than confirming the downside. A little bit in the diamonds, which is the Dow ETF, but it's a slight relative positive divergence. You see price here is just basically almost at the same level over here. 3C is a little bit higher. It's nothing big. It's nothing big. I wouldn't, go all in on anything like that. But what was interesting, like I showed you the SPY in the short term, what I would like to see in the short term as we move forward next week is positive divergences in, these shorter term time frames. They are like the most sensitive. They're also, the least meaningful signals, but whenever you get a change in trend or something is changing, you'll generally see it on the most sensitive, shortest time frame first. What's impressive to me though, is I've been using the 5 minute trend to, in SPY to track this rally from October lows, and hopefully that pulls up here in a second. And what you'll see is the 5 minute trend actually still looks really good. I'm like kind of almost amazed. So here is 3C leading higher right into our measured move target for S&P 500 4150. which also meant expecting consolidation. We kind of get like a little, relative negative divergence here, consolidation signal. That's fine, no problems. And then we get this whole dip. So this is where, we see the S&P testing and holding its 200-day moving average. And you can see, this ramp up in SPY here. You can see conviction as the S&P tested the 200-day 3 times in 5 days. This is conviction. So what I'm happy to see is that 3C on this 5-minute chart didn't come down and confirm price lower. So we still have a relative positive divergence here. So there's still hope. Now, I personally would probably be more looking at like NASDAQ long. Like, this is one of the things I kept communicating to my subscribers is like, look, if you're going to be long, I wouldn't be doing it in the banks. I wouldn't express that position in the banks because they're in a situation. But right now we have strong hands, like institutional hands that have rotated into those mega caps, and they're really still holding up really well. So I'm really surprised by that. So this is a positive development, but what I would like to see early in the week or whenever we get there, whenever it's time, is that we start seeing some positive divergences on these really short time frames. So hopefully that answers your question on that. Let me show you market internals, how oversold we are. So I didn't do a video last weekend because my dog's been sick. She's dying actually, but she's having some great weeks. We went to the beach yesterday. The weekend before that, I did like a little section, and if you go back to that video that I actually posted as a video, not just a live, I actually have like, at X minutes, here's how I figure out my 1 day oversold or overbought condition. So we've had 2 extremely oversold 1 day conditions, Thursday, Friday. As far as breadth oscillators, I like this 13-week new high, new low index. This is a little bit ugly right here, but so what you're seeing is it's an oscillator. The S&P is below it, and the oscillator is in white, and it runs on a scale from 0 over here to 100. So 100 would be like sharply overbought, and typically around, like, I don't know, 10 to 20 has been where we've been oversold on corrections in this trend off the October lows. So we got down, I think, into the 2s or 3s, basically the most oversold that we've been since this October low. These are some sub 1 prints, so they were extremely, extremely oversold. But we are in like really deep oversold territory. Some people asked about the absolute breadth index. And I keep saying, we got 3 signals in Q1 of last year. We've gotten really close to a signal at 14, under 14. But every time we get down there, it just doesn't make it. But the whole idea here is 14 is just a level that I back tested and I found to be like reliable. It caught most of the moves in VIX. But the fact that, it did come down as low as it is, the lower it comes down, the higher the probability that VIX is going to make a big move. So the fact that it came down to like 16 this week may have been like a little bit of a forecast that we're going to see a move in VIX. But generally speaking, I look for below 14, and we haven't seen that since the first quarter of last year. So let me get to the 14 level here. So you can see it back here. And we did get a couple decent moves in VIX, but we haven't seen anything since then. I have to be honest with you, like historically, when I look at this indicator, it maybe gives 1 or 2 signals a year. In 2021, during the bull market, we got like 6, 7 signals. I mean, and they were all good. Generally, what we'll see when the ABI, the absolute breadth index, moves below 14, and it can just be intraday. It doesn't even have to close below that. Generally, what we'll see is at least a 50% move in VIX as early as the next day, but up to about a month. And we've seen some moves like in early 2018 in excess of like 450%. So I don't really use this as an indicator to tell me much of anything unless it's below 14. So it got real close this week. I think it traded down almost to 16 intraday. But again, no dice. So we'll keep watching that for a high probability. And that's when I really like to trade VIX on the long side, is when I get a signal like that. Let me just check the comments again. But anyway, my point was, what I was trying to get to is that, yeah, we're like really deeply oversold here. and sentiment went from really frothy. Like if you look at the fear and greed index, it was like in extreme greed about a month ago. Now it's in last look fear. Maybe it's in extreme fear by now. So sentiment extremes, like extreme greed, is a contrarian signal. So when you see everybody on the same side of the boat's about ready to flip. So if we're back in extreme fear again, then I can actually check it real quick. You're not going to see it on the screen, but just for giggles. And let's see what it's at. Yeah, it's a 24 extreme fear. And that's coming down from 34 the day before, which was fear. And greed a month ago at 70, it was even higher than that. It was into extreme greed. So everything is really kind of oversold, and sentiment is really on the very bearish side. And that tends to be, you know, a contrarian indicator. So again, let me take a look at the comments real quick. So not QE needs to come. Yeah. Looks like my theory holds water. Yep. Okay, can you zoom out and show when correlation changes? J and D. Hey, Kirk. Okay, correlation, what chart were you looking at? I'm sorry. I'm just going to wait for Kirk's reply. Can you zoom out and show when correlation changes? Are we talking about gold and S&P? Or if you're talking about that, then that was March of last year when the Fed started hiking rates. Not seeing an answer here yet, but I know I'm a little bit ahead of you guys. So let me see what other charts I have for you real quick. Oversold, internals, 1 day oversold, breadth oscillators oversold. And we still have really strong looking 3C charts in the SPY. And we have some really strong looking charts still. Let me just transition you back over to TC2000. We still have some really strong charts in tech and these mega cap heavy indexes. They're bull flags. These are pretty much some of the only ones, I think the only ones actually, that have held up. So again, NASDAQ 100, which is full of mega caps, the mega cap index, the most heavily weighted technology sector, the communication sector, which is full of mega caps, Google or Alphabet, whatever you want to call it, Meta, Facebook, and then consumer discretionary, Tesla, Amazon are the two big heavyweights in that. So we still do have all these bull flags in those places. If you want to know where the money's been coming out of, like I said, defensive sectors. So here is the healthcare sector. Look at that. So exact same time frame. Watch this. XLK, right? Technology sector, except different trend lines. Sorry. Technology sector, right? And then healthcare, which is defensively oriented, right? You can see where the money's been coming out and rotating as of like late December into January out of defensive stocks. Let's see, I haven't even looked at XLP. You can see the trends down. There's a little bear flag, right? XLU, utilities. These are all bond proxies. So again, you can see where the money has been coming out of to move into mega caps this year. It's been coming out of defensive sectors. And that actually is bullish in itself because it's showing that investors are willing to take on some more risk than not playing it as defensively. But it hasn't really come out of the cyclicals so much. So my point being is that we still have the stocks that are in leadership that I thought could, and I still think could, lead a next leg higher, although S&P really is not looking good here. Actually, let's take off the trend lines though and actually look at the price trend, because what you will see, as bad as this week was, hopefully you can see that. Here's the October low. This was actually an inverse head and shoulders bottom. This is where my 4150 price target came from that we hit up here, right? What happens 90% of the time after you hit a measured move price target? You get a consolidation, all right? But if we look at this, what you see is still this trend of higher highs and higher lows. What we don't want to see is a lower low over here. So I guess you would say, down below 37.65, something like that. That would be disturbing. That would be into like some toppy kind of price action. So we still do have a decent trend. We can look at this pullback was roughly 8%. This one with this banking crisis scaring the hell out of the market is roughly the same. So it's not too different than what we saw at the end of the year in December with all this tax loss selling. So from that perspective, this trend is still a bullish trend. Horrible week, but it's still a bullish trend. Let me check the comments and see if Kirk got back to me here. Semis are also looking bullish. Thonk, like stonks. I agree with you, Adam. Let me pull up the semis real quick. Not sure I've adjusted the trend lines or not on these. I usually do this over the weekend. So semis, yeah. And semis tend to lead tech. So like in my early update for my subscribers, one of the things I am always talking about in that early update is how the mega caps are performing next to the S&P equal weight index, how semis are performing relative to the tech sector, because semis tend to lead the tech sector. Transports tend to lead the Dow Industrials, or at least they should confirm, because if you go back to old Dow theory, it's not so much the same these days with, Dow Industrials aren't exactly industrial anymore. But the theory of Dow theory is the Dow Industrials, they produce goods and the transports deliver them. So if the economy is in good shape, they should confirm each other, right? You should see just as much activity in shipping as you're seeing in production. So again, stocks, semis tend to lead tech sector, and they're still holding up in a bull flag. So good call, good eye on that. Let me check the comments again. Gosh, I thought I had this straightened out. I do have it straightened out, that I'm sure I'm not showing you the wrong charts at least, but J&D Mail weekly. Can you zoom out and show when correlation changes? I'm still looking for it. Series of higher highs and higher lows since October. Plus, yep. Absolutely, Adam. We just touched on CPI report on 3/14. Looks like month over month is forecast to head up, but year over year is heading down. Okay, so what is your take on how that could affect the market before the Fed meets? Okay, so yeah, on economic data like this, most people are going to look at it on a year over year basis. But the initial knee-jerk reaction is going to be where it came in relative to consensus. And then they're going to dig into basically the report and see where inflation is still, being troublesome. So right now, it seems like the manufacturing sector is already in recession. So most of the inflationary trouble that we have right now is in services. Like, I think most of the jobs that were added in this last report were bartenders and waitresses. So, that's where it's coming from. So the CPI report, yeah, the Fed, Powell made reference to that in his testimony before Congress that, and there was a slight dovish tweak in his prepared remarks on Tuesday, and then the same remarks on Wednesday. And what he kind of made clear was, we're going to be really data dependent, but we're watching the payrolls report, or watching the CPI next week and the PPI. By the way, the Fed is not going to comment on these next couple reports at all until the FOMC, because they went into blackout on Friday. So that takes a little bit of, the Fed tape bombs out of the mix for the next week and a half or so, which I think is good. All right, I'm still looking at the comments and getting some gin and juice out of my sippy cup. I'm kidding, it's water. Okay, any thoughts on emergency Fed meeting on Monday? So I don't know. I don't know. What I do know was, I think it was the Treasury was going to brief the House or the Senate Financial Services Committee this weekend over the banking thing. So there's a little bit of a freak out. I'm not sure if they're going to do the full plunge protection team. So everybody remember, let me bring it up. Oh, it's such a fun chart. Everybody remember what happened in, hopefully I can get to it on this chart. Let me get off trend lines and everything. In 2018, let me clean this up. Let me clean this up. Hopefully I can get back that far. This is the reason I love stock finders. I have so much data. Or TC2000, or TC2007 from 2007. They don't even support it anymore. I still pay for it because I can scroll back to data from the 1915s. I can look at the Dow in the 1915 and see all these cool price patterns. That's the COVID crash, which looks absolutely huge compared to this. So here we are, October 2018. By the way, called this crash in advance. And the reason why was we had some really, really bullish price patterns in yields, and they looked like they were going to break out. And I said, if they break out, man, this market is going to tank. And it was October 3rd, I believe, which is right there, that Powell was doing some kind of interview, and he said, we don't know where the neutral, this is why the Fed was still hiking. Remember I tell you the Fed always breaks something, right? So they were still hiking here. He said, I don't know where the neutral rate is, but it's higher. Okay, so they were saying, we don't know how much more we're going to hike, but there's going to be more. The market sold off starting the very next day. Okay, and this turned out to be, I don't know, I think it was about a 20% decline. But the point I want to get to, yeah, almost 20%. So we had a first leg, big consolidation, and a second leg. So when you see bull flags, bear flags on intraday charts, this is the same concept. First leg, consolidation, second leg. And usually the measured move is very, very similar. But what I want to touch on is what happened, because I think it was right over here. Is that a Wednesday? Right over here, the Fed hiked rates one more time. The market called his bluff. It sold off. And Powell was being, I respected him at the time because I was like, he's not going to be pushed around by the market. And the Fed hiked rates one more time, right? And the market said, ha, okay, puke again. That's what happened. This is Christmas Eve. What happened on Christmas Eve? The plunge protection team was called to the White House. So that's the head of the Treasury. That's the head of the Fed. I think the head of National Economic Council or something like that. It's actually called the President's Working Group on Financial Markets. It's a real thing, but they're called the Plunge Protection Team. And what happened? The very next trading day, so we're off for Christmas, 25th, that's 26. They did an about face. So as soon as the market heard the Plunge Protection Team was called in, that was the end of that sell-off. And you could see on Christmas Eve, it ended at session lows, so it did not look good for December 26th. But the Plunge Protection Team was called in, and boom, huge rally. So the question that was just asked, actually, I'm lagging, so it was asked a little bit ago. Do we think that anything can happen? So it would definitely know that the Treasury is in Washington. Janet Yellen, former Fed head, is in Washington. I don't know about anybody else. It would give the market some confidence, and the banks are definitely looking for that. They're looking for that QE. They want it back. I mean, their whole business model is based on that. And let me just explain real quick what this, let me transition, but let me explain to you why this yield curve is important for the banks. And I'm going to transition that so you can see it. Okay, so we're looking at that again, the regional bank index, KRE, in the candlesticks, and then we're looking at the yield curve in white. This is the 530 curve, 5S30. So basically what happens is banks borrow at short-term rates, and then they lend at long-term rates. Okay, so that's their net profit margin interest. So when the yield curve flattens, what happens is they're paying more for short-term money and they're getting less for long-term money. So their net margin interest suffers, and that's why this yield curve tends to lead the banks. Now we do have, in my opinion, I think the banks did catch down to what that yield curve was selling. And we do have 3 days of steepening. It's not huge, but you can see the steepening here. So that's starting to kind of shift a little bit. So I think maybe the bank's bottom, but yeah, it's going to be important what happens over the weekend and what happens Monday, what is said from all that, because the market's looking for, a boost of confidence. If we get that, we have a lot of great dynamics that have opened a window for those mega caps to rally. So yields being lower is one of them. The dollar having turned lower is another. The yield curve, that doesn't matter so much for the mega caps, but that could help stabilize the banks a little bit. Take a look at questions again real quick. Okay. JD Mail, yes. Gosh. Oh man. Oh, can you post VIX versus ABI? Yeah, I'll post that. Okay, and gold versus SPX. So gold versus SPX, real quick. That correlation, I can tell you, started March of last year when the Fed started hiking rates. I'll pull it up again real quick for you and transition to that. GLD, we'll do that in blue because yellow doesn't show up great. Okay. And I'm going to just transition you over to that again. So that's what you're looking at is the S&P 500 in the candlesticks and gold. Gosh, my system lagging here like a... Hold on, give me a second. Hopefully this will move forward. But yeah, that's what you're looking at is, so you see really, there's not high degree of correlation in here if we look real far back. I mean, you could say, yeah, I mean, there were parts where, we did see gold and TLT kind of trend right with the market. But where you see that correlation really pick up is right here, March, when the Fed started hiking rates. So that inverse correlation that both gold and stocks have basically started here. And if we take just a little bit closer, maybe like a 4-hour chart. I don't know that I would say, one definitely leads the other, but it seems like gold has been leading a little bit more. That 4-hour chart's too long. Let's do a 2-hour chart. Oh, it's 4-day. I need thicker glasses, apparently. So yeah, there it is from the Fed rate hikes, gold making a lower high here, the S&P kind of ultimately turning down. Gold kind of doing the exact same thing as the Dow right here, right? With a W bottom. Let me pull up the Dow real quick so you can see. Right here, W bottom and the Dow, kind of same thing as more of like a almost triple bottom at 1620 for gold right there. And they both kind of rally together. And pull up the S&P 500 again because the Dow hasn't done anything since it just rallied, led this rally, 20% gain, but it hasn't done anything. So taking a little bit closer look, we do see that gold, yeah, I mean, it did lead the market lower over here. But the whole reason for that was because the market was acting much stronger than it should have been, considering how much yields went up. Gold was acting much more like it should have been. So if we look at Friday, we come in a little bit closer, gold is acting how the market should be acting right now with yields in the dollar coming down. But of course, we have this panic over the banks. So I think that is a helpful signal. And definitely, like I said before, the fact that the 10-year yield broke trend is exactly what I was looking for. This, what I kept calling a window of opportunity. This is that February hot inflation data. This is the break of trend. Mega caps have, like last year, anytime this would happen, the mega caps would be down huge. And when this would happen, they would rally. So we do have a favorable environment right now. We could use some better signals like the short-term 3C charts on intraday. High yield credit, I would like to see act a little bit better than it is. It's holding up. It's doing enough. But it's not something pretty or something I would point to and say, look, this is super high probability. We're definitely deeply oversold. So I think, yeah, there is a good potential. And we just have a lot of really good charts in tech and in those mega caps still holding up. Let me check those comments again because I know there's a couple I missed. Can you post VIX versus ABI? Yep, let me pull that up. Let's see, ABI. I don't know that it's gonna. What I'll do is maybe I'll do a post on this in the week sometime so you can see kind of like a better correlation. But let me switch this over. I don't think it's gonna make a whole lot of sense until I like really break it down and show the sub 14 levels, like paint them. So we have VIX here, and we have the ABI in white. So you can see this huge move. Yeah. Is that right? Yeah, ABI is in white, and we have VIX in the candlesticks. Maybe I can paint these real quick. We'll have to go out to, let me see if I can do it. Let's see, price below, percent change, net change greater than, less than 14. And let's see, what color should we paint it? Red's not a great choice, is it? Blue? Try that. And we're going to put this on there. And I do have to change it once and then come back. So these blue painted areas are when the ABI fell below 14. You see a big move in VIX here. Over here, below 14, big move in VIX over here. Over here, below 14, big move in VIX over here. This was the first quarter of last year that I told you we got a couple signals. Not really big moves in VIX. If we go back, hopefully we can get back to 2018 Volmageddon. We got one of those signals right here before Volmageddon over here again. So you can see when the ABI does, and this is what I was talking about, you know, that I did back testing. It's like 14 is not a, if you were to find ABI, the absolute breadth index, on another charting system other than TC2000, it would be displayed differently. TC2000 or Stock Finder does a percent change thing with it. It doesn't matter the exact level. What matters is that it's an extreme low. And what I did was just went back and said, you know, what extreme low catches the most of these? Now, the lower it goes, the more high probability it is, but at least below 14. So where you're seeing this indicator painted blue, that's below 14, and you're seeing big rises in VIX. So that's why I pay a lot of attention to that. But as you can see this year, we don't have any. We got close a few times, but no cigar. Okay, so let me take a look at the comments again real quick. Hopefully I got that all for you there, Kirk. As you say, a day is not a trend. Exactly. A day is not a trend. And, you know, the market spooks. The market spooks. Once it starts trending, then we have some issues. Yeah, you're exactly right. Exactly right. So I think that pretty much covers it. Unless you guys have any other questions, I think moving ahead, first, I'm really excited about the new website because of, I mean, like, I love the questions that I get from you guys. I love the charts that I get from you guys. Kirk, I've known this guy forever, fantastic trader. Is the 0 days to affecting ABI VIX? I don't think so. No, I don't think so. But anyway, I get fantastic charts in the email all the time. And I think it's just going to be awesome for you guys to have a room that you can share this stuff with each other. I could pop in once in a while and, you know, we can chat and all that. So that's something I'm excited about. Almost there with the new website. A couple people have offered to help test out the Discord. That's already hooked up. I've got a room kind of set up. So when you log in to the website as a subscriber, you automatically can log into Discord. So it's not like a public room or anything like that. Next week, PPI and CPI, those are going to be important. But I think really, you know, as a lot of you pointed out, what's going to be more important is kind of what we hear from the White House or the Fed or the Treasury. I know Janet Yellen was out on Friday, former Fed Chair Yellen, who's now the Treasury Secretary, basically saying, don't worry, we're well capitalized in the financial system. But yeah, I think we're definitely going to see something break, whether it's the banks or whether this was like a one-off thing. I don't know. But we will see something break. Then the Fed will panic, and then the market will stop panicking. What else do we have? Fed's in media blackout, so they're not going to be commenting on those hot CPI, or if it is a hot CPI or PPI report. So the market's going to develop its own narrative without any input from the Fed. They're in media blackout until the FOMC on March 21st, March 22nd. Like I said, we do have a very positive environment for NASDAQ 100, for QQQ, for the mega cap stocks, the mega cap index, the tech sector. We have very, nice looking charts, and we have that open window now. Unfortunately, the market was just in an all out, let's puke everything fear phase. But we do have very supportive conditions for those stocks to rally, and we're deeply oversold, and sentiment is like in the tank. So everybody's on one side of the boat tends to flip. Yeah, I think that's it. Window of opportunity. Anybody have any other questions? If not, we'll wrap this up. And if you do have some more questions that I haven't covered or I missed or whatever, feel free to email me those at the support, which I'll include at the bottom of this video. And other than that, I think we're done, everybody. Hopefully you'll have a great weekend, and I'm going to spend some time with my dog. I don't know how many days she's got left, but she's having good days. She's on like a heavy dose of steroids, so she's feeling pretty good. Thanks a lot, everybody, and I will see you soon.